Hey traders, Jason here from Levitt Brothers. So market's doing really well, right? Trending up, higher highs, higher lows, all-time highs printing pretty much every week. Animal spirits at times coming alive. It's all good, right? Well, it's not all good. There's definitely some warnings out there, which I want to bring to your attention here. I think most of the gains in the stock market have been revolving around AI and data centers and everything about data centers, the physical data centers and all the components of the data centers. And you have like a lot of big businesses that are just buying from each other. But beneath the surface, a lot of consumer stuff is actually weakening. So on the surface, market's doing great, but under the surface, consumers are not that strong. And so this could persist for a little bit, but it can't persist forever. At some point in time, the consumers are either going to strengthen or the market's going to get pulled down. So I want to go through some stocks here. At the end of the day, whatever the indexes say matters less, and whatever the breadth says matters less. Ultimately, it just comes down to individual stocks. If individual stocks are doing well, the market's going to do well. Individual stocks are not doing well, market's not going to do well. So I'm going to look at some consumer stocks, and then I'm going to look at some of the stocks that have done really well just to see what's kind of going on beneath the surface. All right, first we're going to talk about restaurants. Here's Chipotle, obviously trending down, big losses last week after earnings, stock gapped down a whole bunch, okay? I've seen this a lot in the restaurant industry. Here's Domino's, been trending down quite a bit. Some talk about like, hey, if the consumer weakens, they'll trade down to like Domino's because it's, a decent product at a lower price point. Not happening. Stock's been very weak. Brinker, same thing, just trending down. Maybe data center stuff are doing well, but beneath the surface, you got restaurant stocks like Brinker, who's a pretty big company with a pretty big assortment of restaurants, not doing well. Dave & Buster's, the ultimate discretionary stock. You don't have to take your kids there to either eat or play. Stocks, more than cut in half. Now expanding out to just general consumer stuff. Celsius, new high just a couple weeks ago, but today after earnings, gap down huge. Okay, a little bit of a sign. Celsius is consumer discretionary. It's kind of a nice to have. You don't have to drink it. If you want to cut back, this is a place that you could be cutting back. Duolingo, same thing, been trending down for a long time. If you want to cut back, abandon that ambition of learning Spanish or whatever other language you want to learn. You might cancel your subscription there, and that's happening here. The stock's been clobbered over the last couple months. Elf, did well for a while. It trended up and then moved sideways June, July, August, and then moved up again, topped, and now it's, today it's down more than 30%. Kind of discretionary, kind of not. A lot of women, think it's necessary in the workplace, especially today with the job market being iffy. People want to look their best. Moving on, Home Depot did well, but been trending down for a couple months. In fact, it's been trending pretty much topped as soon as the Fed lowered rates back in mid-September. So it's a little bit of a sign, hey, we'll hold off on that home project. But you got Ross Stores doing really well. Hit a new high yesterday, and you got TJ Maxx, TJ Companies also doing well. It's mostly consolidating in the last few months. So you got consumers are trading down from maybe some discretionary stuff, maybe some more expensive stuff, and going into like the cheaper stores to get the stuff that they absolutely need. Now let's look at some of the speculative growth names that have done really well and see how they're doing. So here's Joby. I kind of like this stock. At least I liked it as of a week ago. I saw this as a kind of a decent size cup and handle. Boom, except it fell out there. You can see after earning, it had earnings recently, but it actually broke down before earnings. So instead of trading in a cup and handle within an uptrend, looks like it was going to at least move up to 20, get to the top of the range, and then it could break out there and go well into the 20s. Instead, it broke down. So now it's just like a big consolidation pattern within an uptrend. It's unchanged going back all the way to July. So instead of doing well, it's just at best it's neutral now. Here's Oklo, another one of those stocks that did incredibly well, posted huge gains for a long time, but came down hard. You can see a hump here, rally to new high, came down really hard, lower high, looks like kind of like a head and shoulder top right at the neckline. This is more likely to fall down than it is to bounce here. Okay, so the animal spirits are no longer alive. Rigetti, one of those quantum computing names, obviously huge gain here. We played this at Levitt Brothers, broke out here, had another breakout over here, ran up high, but fell super hard here. Kind of support there. We got like a rising wedge here, which it broke down from a couple days ago, and now it's sitting at another support level at 35. And it, like Oklo, it looks more likely to break down than to break up. So, again, those animal spirits are no longer alive. Here's RR, speculative robotics name. Is it a household name? No, but one of the characteristics of the rally, that we've had August, September, October is that like some of these speculative growth stocks kind of came alive. They posted huge gains. The animal spirits were alive. People were throwing money around, but the stock's been trending down for a month. It's pretty much almost cut in half. So you can kind of turn around and say, hey, maybe, people are not willing to do this, not willing to take a chance. They want a little bit better business there. They'll buy a solid company, but they're not going to roll the dice with like a robotics company that might not play out. It's kind of gives you a glimpse of like the psychology of what people are thinking right now. Again, stock's almost been cut in half. So again, the animal spirits are not alive anymore. Okay, last one. Whoops. Here's the last one, energy fuels. So as the data center stuff got hot, those data centers need to be powered, right? So nuclear power, uranium became a big thing. If you have uranium, you're doing well. You could sell that stuff. Moved up, consolidated, moved up, consolidated, moved up. Tested lower a couple times, ran up. But, obviously it fell hard here, tried to bounce, and now falling hard here. Stock's almost gotten cut in half. So again, the animal spirits are no longer alive. The market has a personality. It has a character. This changes throughout the year. Sometimes stocks are alive and you can just kind of throw money around at anything that moves and you can make money. Other times you got to be a lot more careful. Right now, it is not an easy environment. It is a harder environment. You can't just carelessly throw money around. Looking beneath the surface here with the consumer stocks weakening, a lot of the high flyer, speculative stocks are weakening. Even if we do chop around here, bounce, rates will come down again. The government shutdown will end. People, Wall Street has a short, they have a short memory. Eventually things will get better. Even if we do rally into the end of the year, into January, I think what we're seeing right now is kind of a warning that this is, the wheels are coming off a little bit. Okay, tops don't form really quickly, but I think the seeds are starting to be sown for a top sometime next year. Okay, and that's assuming we do bounce here. All right, hope you got something out of this. Hope you're doing well, and I'll see you next time.